Very welcome to all of you. As a system, we have passed the first stage of financing. Maybe in the second stage, we take these learnings forward. So we will have to probably look at some of these innovative financial solutions. In power markets, can we still look at a debt load of 30/70 or 80/20? If you're going to have power plants with PLFs of less than 50%, which is today the norm, can you have debt equity load? So you are basically asking someone to run beyond his capacity. So I think solutions lie within existing regimes of regulation. We don't need some exotic structures. It's just that we need to think how we model those risks. Unfortunately, what we have taken in the first stage of financing is the best case possible. So we have taken the best traffic case, the best possible financing solution into a most aggressive one, and that's where we are. But life doesn't work on a very predictable manner from a 20-year perspective, and hence we need to build in buffers for a possible downturn, and that's where the confidence of a global investor comes in. What is the difference between a global investor and a domestic investor is, and when I used to ask some of my colleagues who used to come from international experience, they say, boss, we don't work on jugaad. And jugaad in India is for innovation that we will manage the situation and resolve it. The global investor is only looking at predictable, stable return. So you will have to build all buffers in terms of financing upfront. If we are able to get some of these things right, I think you can see a lot of capital flowing into the country. So I think that's where I would stop at. Maybe I will ask Mani to share her experiences in terms of what are there in the international arena, especially in terms of financing, and how you think it's different from India.
When it comes to innovative financing, we actually have very good examples from our India experience. And considering we are all talking about the REVA story today, so this is something that I think World Bank and IFC worked very closely together. And what we were able to see was low prices coming in through the tariff. But how did it come about? Basically, there are numerous stakeholder consultations, and we speak to a lot of developers. We speak to each and every stakeholder. And what came about was the shared infrastructure was a major problem. And so whereas we knew that the financing did exist, but the problems were there were so many risks which were increasing the cost of financing. So the idea was to take care of the risk in that. So World Bank came in with a project which would take care of the shared infrastructure, and IFC came in with the idea of helping the state utility, the state government work on the contractual issues to make sure those risks they are equally distributed so that the cost doesn't go up. The cost to the consumer doesn't go up. So basically where the World Bank actually comes in, the World Bank group, is about seeing that the allocation of risk is done efficiently so that the price that comes out, is the lowest possible in that manner.
When you're still need to take some of these projects to bond markets, how are you packaging some of these, or overcoming these challenges, how the investors are perceiving infrastructure?
We delivered something on a partial credit enhanced structure, which was IFCL ADB back-end structure. Small trade, 450 crores, felt very bullish, pre-interval Bollywood movie. By second half, the climax was getting more and more suspense. Most of the investors that we counted on could not participate, and finally, some new set of investors did come in, and we were able to distribute it over a 14-15 month. Some investors realized that regulatory hurdles are still holding them back from investing. We got a negative response across all the fund managers. Provident funds, yes, some of them bought into it. So clearly, the investor segment that you depend on, which expectations that they will provide a 15, 18, 20, 22-year funding line, are not somewhere on a table to discuss participation. They are just hands-off all the time being. So there are issues with a lot of those constituents' participation. one point which can make bond markets thrive, either take away the MTM pain from them or make loans MTM.
Sandeep, on the road side, you represent a new age fund who's sort of looking to buy assets, repackage them. What would be key deal enablers from buying more assets, if I may say, for you?
The one great enabler which will enable us, and not only us, but other people who are looking at coming into this sector, is the way the loan are structured so that they get something in cash yield for equity investors. Frankly, I don't think we need to do as much innovation as possible. So long as people, both private regulators, lenders, have a very, very basic pragmatic view, I think the problems of this sector can actually disappear very fast. What we are also seeing is some bit of regulatory help required on the debt financing side. And we need to take, roads for example, need to take lessons from other sectors such as renewables. So for example, in renewables, you actually can pool cash flow. So two projects which are struggling and two projects which are good, from a lender perspective, you pool the cash flows, the lender still makes his DSCR, still makes it. In roads, you have the typical SPV structure. One road can be extremely good, but if two roads are, and that road has huge cash flows, but two roads, there is just no possibility of pooling those cash flows. Very simple kind of solution. It's being done in renewables. Don't know why it cannot be replicated in highways. I think similarly, in infrastructure debt funds, for example, right? They actually work out a structure where you have a running coupon which is probably 4 or 5%, and you actually have a long structure where you still make a yield of 10% and all, right? The regulator, the RBI, doesn't allow probably that to happen in banks, and IDFs have done it. On roads, IDFs have done it, but banks still require 10% coupon servicing. Some projects can serve it, some projects can't serve it. So I'm saying that you don't need to think out of the box. There are precedents available today. It is being done in roads today by, let's say, non-banking financial corporations. We talked about bond markets. I just want to share one perspective on bond markets. We are seeing bond markets now slowly getting amenable to toll roads also. Of course, annuity, they've done a lot. But the capacity building required in bond markets for highways is huge. There is a big lacuna. That capacity building in bondholders, especially mutual funds, insurance, in terms of understanding what they're getting into, is a huge thing that we should probably think about.
Last but not least, Juvenal, what are your challenges when you go for your project finances, which you encounter from the investor community?
I think oftentimes in India, after the project is financed or during the financing stage, it's post the financing, it's basically the lenders worry whether this project will sustain and it will run or not. But we do so much of brainstorming and we do so much of simulations that it can put any lender to shame as to how much we try to work on and how much management time we spend on the sustainability of a project. So two things very clearly for us is whether the returns, both for the equity holders and the debt guys, is sustainable when we try to structure a product, structure a loan more specifically. And the second thing is the risks associated with it. Just a case in point, we have one thermal, we actually have two thermal assets in the country, and one of the thermal assets has all the PPAs and coal linkages and everything and all that jazz. And we could complete the refinancing and everything. The second thermal asset, it's completed commissioning. We are operating on short-term and medium-term PPAs. And though we felt that this model can sustain, we are able to service the debt and everything, but we thought that for the time being, whilst our long-term PPAs are in the pipeline, let us restructure the debt. So from 70% debt, we reduced it to 30%. To just make sure that for the time being, when the project is having a little bit of challenges, let us stay with it, and then effectively, when things are good, we sort of refinance or do some things like that. And the lenders often in the country are willing to take development risk, but once the project is operational, they try to scare themselves away, and also they scare the promoters that you have so many risks. So I think that's our perspective, that we look at things from sustainability point of view. And I think even the innovative structures that lenders and we all work on jointly should sort of reflect that, so it's a win-win situation for all of us.